Hi, everyone. It's Peter Griffin. And at the Consumer Electronics Show in Las Vegas on the 8th January, NVIDIA CEO Jensen Huang stunned the audience, warning that very useful quantum computers are likely 15 to 30 years away. Although our target firms have no direct link to NVIDIA's roadmap or earnings, his remark alone triggered a massive sentiment-driven sell-off. Each stock fell 45 to 60% on January 8th, whilst trading volumes spiked by 178% to 374%, far outpacing the NASDAQ composite. Clear deviation from fundamentals suggests a violation of the semi-strong efficient market hypothesis. But what do I know? Now I'm going to pass on to the rest of our team.
In this short video, we conduct an event study to quantify whether Jensen Huang's comments at CES induced statistically significant idiosyncratic price moves in our target firms, IonQ, D-Wave Quantum, also known as Qubits, and Rigetti Computing. Our central question is, can we statistically detect an idiosyncratic abnormal return post-Q&A, one the classic efficient markets hypothesis can't explain, but behavioral biases can? Before I give you the results, I must give some context surrounding variable choice and setup. For data and benchmarking, we need two benchmarks to isolate jargon-driven noise. We chose the NASDAQ Composite CCMP ticker as its tech sector proxy and the Russell 2000 RTY ticker as it's comprised of the smallest 2,000 US firms in the Russell 3000, accounting for the small firm drag outlined in Bands 1981. In reality, we can't just take the raw difference as this would assume that our stock moves one-to-one with our benchmark. We must understand that each firm has its own beta. For this transformation, there are three intermediate steps to statistical testing. Firstly, we run an OLS regression for each firm and each benchmark. The parameters alpha and beta capture each stock's typical sensitivity and intercept. We use an estimation window of 120 days pre-event study, aligning with Brown and Warner and McKinley, whereby 120 days is the industry standard for pinning each firm's alpha and beta with precision, whilst not causing a drift in the underlying asset's return. Secondly, we compute abnormal returns for each event window. We do this separately to get two abnormal return series per stock. Finally, we sum abnormal returns over 3 event window lengths: 5 days, 20 days, and 60 days. For statistical testing, we use both a parametric and non-parametric approach. Here we pay special attention to the non-parametric Corrado Z-score due to its non-normality assumption, accounting for the fat tails and skewness in thinly traded, highly volatile small caps. Unlike simple sign tests that only use direction, or the Wilcoxon rank sum test, which compares to 2 independent samples, Corrado's approach uses the entire pooled sample of abnormal returns to construct a standardized Z-score. Moving on to the results, we see a robust 5-day abnormal return for IonQ and Qubits, yet this dissipates by 20 to 60 days, aligning with behavioral overreactions rather than fundamental revaluations. Behaviorally, we can see Huang's credibility triggered a firm-specific jump that far outpaced broad tech or small cap moves. We can also see the availability heuristic, which relates to investors' judgments when making investment decisions. Investors overgeneralize Huang's 15 to 30 years caution from NVIDIA to all quantum plays, without delving deeper into other sources driving the knee-jerk sell-off. What we can also see is a celebrity endorsement effect. Huang's negative viewpoint at CES 2025 prompted a sector-wide flight, which only gradually unwound as the firm's fundamentals began to reassert themselves.
Thanks, Jake. Now we speak about trading volumes and realized volatility. The simultaneous surge in volatility and the volume is a classic herding signature. Once a handful of investors panic sell, others rush into thinking they must know something I don't. The wild spike in volume, up to nearly 400 million shares in a single day for Rigetti, reflects a fear of missing out. Investors abandon their usual screening processes and just chase whatever's most salient, flooding the market with orders as per DevNow and Welch 1996. A jump in trading activity widened bid-ask spreads and creates greater slippage, which makes prices even more erratic. Seeing this volatility, short-term traders and algorithmic systems rush in with stop-loss orders and reactive trades, driving volume up again and perpetuating the cycle.
Ultimately, what we've learned is that a single high-profile comment can send sentiment, volatility, volumes, and returns wildly off course. Under prospect theory, losses feel about 1.8 to 2.5 times worse than equivalent gains, which drives the disposition effect. A stop-loss threshold forces you to take small, controlled losses before that steep pain kink in your value function kicks in. It stops you from watching a position bleed, trading that "I can't close this at a loss" reaction for a calm, rule-based exit. Hessner et al. 2009 conducts an fMRI study to show how pre-commitment boosts dorsolateral prefrontal cortex to ventral medial PFC connectivity, shifting control from emotion to planning. Repeatedly executing these volatility-adjusted stops strengthens habit circuits, turning stop-loss deployment from arduous self-control into near-automatic behavior. In this sense, it's a behavioral shock absorber.
Thanks for listening. Please consult our reference list and feel free to ask questions.